Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending September 20th, 2024. I'm host of InvestTalk, Justin Klein, and financial advisor. And this week I'm titling the video Fed Cuts into Strong Data and Moderate Inflation. And this is a lesson you really need to internalize, which is the Fed and central banks globally are going to err on the side of creating more inflation as opposed to deflationary problems like the Silicon Valley banking crisis, like what happened with the COVID crisis, etc. We'll look at the data, but it's pretty clear that do they really need to cut 50 basis points? Probably not. Now they did uh, project a bit more hawkish path of policy than the market had been anticipating, but the market priced in something pretty extreme. So it was a pretty interesting reaction. I'll show you why, and that's one of the reasons why the 10-year, I'll pull that up here, 10-year was up a little bit this post Fed meeting, right? Bottomed at about 3.6. We closed at 3.72, almost 3.73 on the 10-year. So that was an indication that the market was pricing in too dovish of a Fed pivot, or they're also expecting inflation to reaccelerate over the medium term. So that was that interpretation. But I'll go over this real quick, which was the heat map here over the last week. And NVIDIA was down about 2.5%, but you had some good strength elsewhere in technology. Apple up 2, AMD, Broadcom, Cisco up nice about 4.5%. I think they had earnings, or was that Oracle? I can't remember. But definitely some good moves. Meta up 7, Google up 5. But look at the strength of the financials: Wells, Blackstone, BAC, American Express. Besides Berkshire and J.P. Morgan, there was a lot of nice strength. KKR up 10%. What else? Retail, Amazon up 2, Home Depot and Lowe's doing well. Obviously, lower interest rates will likely help them. But even product manufacturers, look at GE up 10%, AMAT up 4. So some nice strength here. Weakness definitely in the healthcare sector overall. You see that here. UNH down about 3%. Even health technology, right? Just kind of neutral. Yeah, Lilly down a little bit. Just not a whole lot of strength there. Consumer non-durable, same thing. So a lot of the and this goes back to bond proxies, right? When interest rates go down, bond proxies rally, and you saw, if we go back, zoom out to like a monthly chart, what you can see is there's just still a lot of strength in healthcare outside of the Eli Lilly, finance doing well, but look at the utility sector. If we go all the way down, where is utilities? There it is. Look how green this is over the last month because it's a bond proxy. Same the consumer non-durables, that up nicely besides Pepsi. Retail continue to do well. So overall, this is a bullish market. That's really the only way to interpret it in the medium term. Although, we're still in the seasonally weak part of the year. We have the election coming up that could throw a wrench in things. But overall, you can't get too bearish because the charts across different sectors remain relatively robust. Now, from the economic perspective, the economic data was pretty good this week. Fed New York Business Leader Survey that was positive for the second month in a row. Industrial production turned a bit positive year over year. Retail sales still hanging around the 2 to 3% range. That's fine. It's not great, but it's fine. Housing starts reaccelerating. Remember, this is big because if you look at existing home sales, that was pretty poor, right? Down to about 3.86 million. But what's more important is the new home market, because that creates a lot more jobs. Think of construction workers, for example. Demand for oil and diesel fuel to move all that material, etc. That's a lot of economic activity. And housing starts in the month of August, certainly reaccelerated, and will likely continue to accelerate in the month of September as well. You see that with permits on top of that, kind of reaccelerating, coming off a bottom there. And then if you get to the employment situation, look at the continuing claims for unemployment. What was a breakout, right? We were hanging around this 1.8 million level for a while, and then in early June we broke above that 1.8 level, hit a high of about 1.87. Now we're coming back to that 1.8, right? 1.83 now. So that's certainly a picture where less and less people are on the unemployment doles. That is obviously positive for the labor market in general. And then you have to look at layoff and discharge rate. So what percentage of workers are being laid off? It's still hanging in the 1 to 1.1% rate. Okay, this is not accelerating. Okay, if you go back to, obviously this is the COVID crisis, so a lot of people that were laid off. But if you go back to '08, this picked up to about 2% in '08, '09. So you're still hanging around these relatively low levels. Then you look at the GDP now number that is from the Atlanta Fed. That's at 2.9%. Long-term growth is around 2%. So that looks fine as well. And then the bank credit. I talk about this regularly. If banks are lending, it's hard to have a negative um, economic shock, because people can finance themselves. Corporations can finance themselves, so they're not forced to lay off workers, not forced to curtail spending, etc. Right? People tend to continue on with their with what they're doing on a daily basis. Businesses continue to go on with what they're doing on a daily basis, unless something uh, exogenous happens with their business or their personal life, right? They get laid off, or if you're a business, you can't pay your bills, right? You start laying off workers and being forced to cut staff. So that's but when you can borrow money, that tends to not happen, right? And so what you see here, if we zoom out to like a 5-year chart, you can see this is 2022 and that big drop in growth in credit. It went negative in late 2023 and early part of this year, and then went positive in the spring. And so as long as that stays in an uptrend, that is going to be good for the broader economy. Okay. Now, the Fed, they prognosticated more rate cuts going forward. They did pull some rate cuts from 2026 and 2027 into 2025. So, in some ways, that was a bit dovish. But what's interesting here is the Fed, the market's still expecting about a 51% chance there'll be a 50 basis point cut in November. And then if you look at December, they're coalescing around basically 75 basis point cut between now and the end of the year. There's only two more meetings, so that means one of those meetings is going to be 50 basis points. I would actually fade that. I don't see a reason for them to go that hard on rate cuts, and obviously the dollar is going to be a big factor in that. And there's something underappreciated about the a strong dollar. A lot of foreign investors pouring money into the U.S. market, and a lot of that has to do with the strong dollar. If the dollar gets weak, they could be selling off risk assets, selling off equities. So something to consider if the dollar does continue to get weak. That could be bearish for I think more mega cap tech than I think the broader economy. I think or the broader markets. I think small caps would benefit from a weaker dollar. Obviously, materials and energy would benefit from a weaker dollar, which is in a high weighting in the indexes. But I do think you would continue to see a rotation out of this growth and into value, and we saw that in July. With that big sell-off, and this is trying to get some more traction on the growth side, but it's not really, right? And the MACD is below zero now. It's making now, it looks like a lower high. We'll see what this looks like at the end of the month. But ultimately, this still looks relatively bearish for growth versus value. And is it a coincidence that the July was the start of the downtrend in the dollar? Okay, and it'll break lower in August. So, and this little bounce in September is pretty meek and really portends to a lower dollar going forward. Now, the positive for the dollar is that the yen, or the Bank of Japan, did not raise rates again, and that gave a little weakness to the yen. But you can see that didn't translate much into the dollar strength. You look at euro; the euro was pretty strong. Um, uh, the euro was pretty strong last week on the back of the Fed rate cuts. Here's the Canadian dollar. uh, there's the Swiss franc. That one remains relatively strong compared to the dollar. This is all compared to the dollar. So overall, I think the currency trade, it could color the leadership in markets. You have industrials remaining very strong. Here's the industrial chart. Look at that. XLF, that continues to be very strong. Now, if you look at something like the KBE index, not nearly as strong, right? If I run a KBE to the XLF, you see, this had a nice little bounce here in the month of July, but since it's kind of rolled over, and so it just shows you that, I'm not really a huge fan of the banks in this environment. Now, parts of the financial sector, yes, but overall, I just don't think the banks are a great place to be. Now, from the credit perspective, here's the short-term junk to short-term treasuries, and this remains very strong. As I've said before, with bank credit, unless you have a negative credit cycle, it's hard to see things blowing up, right? Hard to see a major pullback in equities, and that's kind of where you're at. Here's let me rerun these, right? This is at new all-time highs. Cut these out here. There we go. And this is a pretty high volume. That was interesting on Friday. Obviously, that was OPEX week, so there tends to be elevated volume on those days. But the MACD is not getting much traction to the upside, and that's why I'm still a believer that in the shorter term, you could see more volatility, some more choppiness in markets. Now, ultimately, I do think you get past the election, get closer to the Thanksgiving timeframe, you tend to have just a light volume float, Santa Claus rally into year end. And I think that's the likely path. But, could you have a pullback, maybe into 5,300, 5,400 on the S&P? We're at 57 now, before that rally commences. I think that's certainly possible. The earnings projections going forward, not as rosy as the market is showing here. So I think a bit of choppiness is likely in order. Now, if we go to the VIX here, that's another indicator. Let me zoom in. You have that big spike here. Let's do this. There we go. This, as long as we stay above this, call it 15 and change level on the VIX, this is a bullish flag. So could we see more volatility next week? Would not shock me, right? We still have, what are we, 6 weeks away from the election, and we know with the contentious environment that we're in, there easily could be political violence. Could there be some major event that causes the market to have a little bit of a of a spike in volatility? Would not shock me at all. Now, another aspect, though, that tells me that any little spike in volatility in the near term is probably should be bought is the move index. Look at this. This is trade in a downtrend. The treasury market is not really having any issues. It is just fine. So, unless that gets some traction to the upside, I think overall it should be a relatively bullish market into year end, despite my expectation of near term pullback. And here's the NYSE. Obviously, it's a much broader index than the S&P. Shows you, look at the new highs. This is starting to outperform, like especially the Nasdaq. Let's look at the Nasdaq here. CMPQ. This is NYSE, right? Ratio between to the Nasdaq. This is in an uptrend. This kind of looks a lot like small caps to the Qs. That one is in an uptrend as well. And let's look at the Qs. Look at this relative weakness in tech versus the broader S&P. We talk about S&P at new highs. The Qs are still off those new highs, and if there is a there is renewed weakness in tech, obviously it's going to kind of weigh on markets, and that would not shock me at all to be the leader to the downside in markets would be tech in my mind, based on kind of the setups that we're seeing. Let's look at gold. Gold at a new all-time high again. Nobody's really talking about it, right? Look at GDX, new 52-week high. So precious metals remain very, very robust, especially as you get a weaker dollar, you get lower interest rates. I still think this is a place that there's not enough people allocated to, and I think there will be more and more allocations, both on a sovereign level from Russia and China, India, et cetera, but also think of the domestic consumer, domestic trader, the average retail trader. They're not on this, right? They're not on this train quite yet, and I think there's a lot of dry powder to potentially pick up the precious metal space. So I still remain relatively bullish there. And that about does it. Still seasonality is could throw a wrench in things, but overall, you can't be too bearish in markets. Could you see a 3, 5, 7% pullback in markets? Sure, that's always kind of possible. But there needs to be a catalyst, and in election season, I think there definitely could be. But overall, what I'm seeing is something that uh, looks bullish into year end, and that means you don't want to be trimming positions too aggressively. And if you have a lot of dry powder, dips probably should be bought generally, depending on the sector. But obviously, we talked about what sectors and style factors in markets that should likely outperform in the short to medium term. So that's where we're at. Thank you all for tuning in and liking and subscribing to this channel and subscribing to our podcast, Invest Talk. A reminder that the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views on my own do not represent those of KPP Financial or those associated. Have a wonderful weekend.